Hello and welcome to the Mutual Fund Show. I'm Neeraj Chawla. The next 25 minutes, we'll talk about the mid-cap and the small-cap category. Now, the reason why we thought of doing the show today, one, if you saw what the AMFI figures yesterday showed about mid-cap and small-cap flows, while active large-caps flows were lower, while large-cap flows were lower, while flexi-cap flows were lower month on month, mid-cap and small caps had an uptick. So therefore, that was one good thing that happened, that that end of the market is seeing inflows. So that is part one. Part two is that if you look at the last stock at the small cap end of the market, it's stock number 250 on the all market cap, right? That value, that market cap is northwards of 30,000 crores. The small caps are now very large and therefore they are liquid enough. And therefore, the question that I'm asking to everybody is that why should one hesitate from buying into mid-cap and small-cap funds? Because these funds do have the option of buying into fairly liquid names, and all of these in some sense can also be leading companies in their sectors. You don't have to be a Nifty 50 company to be a leader in the sector. Let me pose this question to our two experts today. Santosh Joseph, founder of Germinate Investor Services, Prableen Bajpai, founder of FinFix Research and Analytics. Both of you, thank you so much for joining in. It's not a very easily accepted point, and the general the general advice these days, Prableen, I'll start with you on this, is that stick to the safety of the large caps, maybe invest more in large cap funds because mid cap and small cap valuations are high. Agreed. But it's a very large bucket and now a very liquid bucket as well. Why should people not invest more into mid-cap funds or small-cap funds?
Good afternoon, Neeraj. Good afternoon, Santosh. I think a very important question, and Neeraj, my answer would be that you should continue to invest in the small caps and mid caps as well. And I would want to, give some data to sort of support my answer here. Of course, the valuations, what we've seen in the past, let's say a year and a half, the kind of inflows that we've seen, that's been riding on the spectacular performance that we saw in 2023. And of course, that is somewhere, on the pillars of, let's say, decent corporate earnings, the domestic liquidity that we've seen, and the newer interest by the investors in segments where they feel that the returns have been good. So recency bias to some extent has been there. But if we just go back, let's say 2016 onwards, and I'm taking 2016 because we have the small cap 250 index since then. So if you look at 2016 onwards, in the past 9 years, including 2024, we've seen year-wise, if we see corrections in the mid-cap space in 2 years, in the small cap space, the 250 index in 3 years, where it was negative on a calendar year basis. Now, if you are going and putting money as a lump sum, then you can be in for a very, very bumpy ride because it takes a decent amount of time to recover. So the biggest correction that we saw in the recent times since 2016, period-wise, has been the COVID, when mid-caps fell by about 44%, small caps fell by about 67% during this period from January till March. The second big correction came in October 21 till about June 22, when we saw the small caps fall by roughly 26-27% and the mid caps fall by about 21%. And the length of that period was from 154 days for the small caps till about, for the mid caps, it was about 245 days. And the recovery for the small caps took 260 days. So this data and the other corrections that we've seen, since 2016, the biggest corrections, the biggest 5 corrections that we've seen in the small and mid-cap space, Neeraj, 3 out of those have been like in this recent time, post-COVID, basically. So the point I'm trying to make here is that if you're looking to invest, there is high growth potential, absolutely amazing returns you can get from these two segments, but then you have to be prepared for a bumpy ride. And that is why you need to take the SIP route. Because if you started investing via SIP, let's say in April 2016, after 3 years, your returns in the small caps would have been negative and in the mid caps at a very, very meager level. So if you're prepared for that, you must invest in this segment. But if you're seeing returns of 20-22% today, that's the return the investor is going to get. But you have to, sort of navigate through those years of frustration when you would start questioning that, probably I could have got better in a fixed deposit. So if you have the patience, you have a time horizon of 6 to 7 years, definitely continue to invest, but in a staggered manner at this point.
Okay, fair point. Santosh, is your view different? And just adding a layer of a question there, could the next few years, aside of the fundamental performance, on the technical parameters be a bit different for a mid-cap fund manager, because the mid-cap fund manager currently has a much larger market cap and more liquid names to have in her or his portfolio relative to what she had, say, 10 years ago?
So, Neeraj, hi, good afternoon, and hi to Prableen. I will have to go with largely agreeing to what Prableen just said, and I also think your question, both the first one and the second one, are extremely well framed to bring out the best of this hot debate about should we continue in the mid and small cap. While the Amphi data is clear and validating that the investors like to stay in equity, number one, and number two, within equity, they appreciate mid cap and small cap a lot more, is evident. We have data to prove that right now. But I think, like what Prableen added, let me add another 1 or 2 points, that the sheer number of opportunities present in the mid and small cap have gone up multifold. For one, let's take the index. About 8, 10 years ago to today, the index itself has gone up in size almost like 6 to 8 times at just an absolute level. Second is the number of IPOs that are happening. Over the last 5 to 10 years, almost every other IPO is actually a mid cap or a small cap IPO, therefore giving the fund managers and even the opportunities for mid and small caps to choose. While all this was happening, I think we can't forget about 4 or 5 years ago when we had the recategorization of what a small cap is, what a mid cap was, extremely clear, watertight compartmentalization of if you're in a mid cap, what you entail, if you're in a small cap, what you entail. The growth of the index, which is a smaller mid cap, the growth of the universe of stocks, the growth of the companies where the exhibition of the entrepreneurial spirit of the Indian economy is so visible in small and mid caps. The earnings are there, the companies are doing phenomenally well, they're leaders in their category, they are having fantastic margins, and they're also willing to invest money into fresh capital expansion. In fact, today one of the big questions when we ask about capex is that these are the guys who are doing capex. Either maybe they're first time capex or they're borrowing money to do capex, but clearly there's an abundant provision here. So what does this summarize to? That do not look at small and mid cap just because they got a good run and just because they got good flows as a negative sentiment. If you are still going to be aligned to the portfolio construct that you need from a risk origin basis, from a risk appetite basis, it's not bad or not negative to be in mid and small caps, but be clear, align it to your time and align it to your risk horizon. There is still opportunity as long as you're not chasing just the immediate past performance. From a fund manager or a scheme, there's enough of room and there's enough of comfort to manage funds even at these high flows or high valuations or high past performance.
Okay. Okay. So I'm suffice to say that both of you do believe that, subject to a few conditions and permutation, subject to a few things keeping in mind, it is not a bad idea to invest in mid cap and small cap funds even now, despite the, let's say, for lack of a better word, the worry or concern around valuations, if somebody has a long-term point of view. Now, Santosh, I'll come to you on this. If that is indeed the presumption and the thesis under which you are now giving the recommend or advice, what kind of mid-cap funds would you believe you would be comfortable recommending to your clients or to our viewers at large right now? And everybody will do their own due diligence, of course, remember. But what kind of funds and why so?
Neeraj, I'll begin by saying that traditionally we are looking at funds based on either 3-year, 5-year performance, and sometimes we like to triangulate the fund that's done well on 1-year basis, 5-year basis, 10-year basis, and you always want to fall back on large numbers and averages to support your view. But I think today India as a market is offering opportunities for newer funds, for smaller funds, for bigger funds. If size was a constraint, then when you look at a Nippon small cap fund, it is one of the biggest in the category, yet it has been been a good performer. If size were not a constraint, some of the small cap funds have great opportunities in terms of the percentage exposures they can take. I think you also are spoiled for choice today in the style of the fund. There are some who run a small cap and a mid cap hugging the benchmark. There are some away from the benchmark. Because of the vastness of the universe of a small cap or a mid cap, it gives you the reason to choose fund. In fact, my list of funds are very clear. There is an opportunity in a Bandhan, Nippon, Edelweiss, HDFC, maybe even a Franklin smaller companies fund. Likewise in like a HDFC mid cap or a Edelweiss mid cap, even a Motilal mid cap. There are some 4-5 names which is also on your screen right now, that opportunities are there in these funds. But if you suppose don't like what I'm saying, there's enough opportunity for you to even dig yourself either on the size basis or on the style basis. But the bigger question to answer is mid cap and small cap do offer plenty of opportunities, and you can also choose from the style. Do you want to be away from the index? Do you want to concentrate near the index? Or do you want to go in for a certain style? Not to forget the last 2 to 3 years, you had styles playing out, growth versus momentum or value. And within that, what sectors they are playing out. I think we are in for a great long runway as far as mid and small caps are concerned. And for investors, just on the basis of performance itself, you have so many easy picks to take. Otherwise, if you are able to drill a little deeper, you will get some beautiful mid-size to small-size, mid and small cap to pick and choose from. Literally cherry picking can happen here.
Okay, probably an initial thought from you, then I'll get into specifics and what can be anticipated there. Remember, for both of you, I mean, I'm not asking you to give me an exhaustive list. These are indicative names, but just to give an idea to the viewers about what funds they can research as well. So Paraplin, with that disclaimer, what category of mid-cap funds, are there specific kind of funds, maybe a couple of names, and why those?
Mid-caps, Neeraj, is a smaller segment as compared to the small caps, because the universe is really limited from the 101st till the 250th. And you said that the market size, of course, of those companies has risen. In 2017, it's interesting that the 101st company was just about 29,000 crores, and today the 250th company, the last of the mid caps, is around 34,000 crores. So definitely times have changed and there's enough opportunity, but the universe still remains that 150 stock universe in the mid caps. And if you look at rolling return basis, I'm a strong believer that is what data suggests, that actively managed mid cap funds have definitely found it difficult to beat the mid cap index. And that is something that probably will continue to happen if the markets mature as we move from being a developing to a developed economy. And that is a phase when we'll see the downturns. That is the time when active funds can outperform. So till the time the markets are really going good, I would say that the passive strategies work better. So for investors who really have a longish horizon, who are investing for 10, 15, 20 years, I feel just pick the mid-cap index. That will be a very simple, clean strategy for you to take exposure to the mid-cap space. For those who are looking at slightly lesser, let's say somewhere between 5 to 7 year period, because the performance keep changing, so you can't keep changing the scheme every time. There are phases when growth style works, like Santosh was mentioning, there are times when value is working. Some of the good names which have on a rolling return basis, I think, consistently beaten the benchmark 150 would include names like Kotak, Edelweiss, Motilal now with Mr. Niket Shah, managing it. Then HDFC, it has been a consistent performer for the last 16 years. We have the same fund manager. So these are some of the names, I think, in the mid caps which look good. But my choice would be a simple, clean index strategy in the mid cap space.
So probably, am I getting this correct? You'd choose a passive index strategy over an actively managed mid cap fund? Are you saying that?
Yes,
you are.
I would do that for my portfolio, and we are increasingly doing that for our investors. For the next 20 years, when I'm investing for somebody, Neeraj, I would 100% go in with a mid-cap passive strategy. In fact, that's what we are doing for even investors with anywhere between 6 to 7 year plus horizon now, because it's very difficult to keep looking for the best outperformer. And the difference, I want to give you data here, Neeraj.
Okay.
So for the last, if you're looking from 2016 December till 2024, which is like many years, 8 years actually. So the mid cap 150 index has given us somewhere between 23-24% returns. Now here the difference between the best and the worst performer is almost 13%. So with very fewer schemes now being able to beat the index on rolling return basis, I feel that the mid cap index would always be somewhere in the top quartile. So you may not be in the best fund with the passive strategy, but I think it's a very, very high probability that you would be in the top quartile. And I think that should do the trick for most investors.
Okay. Probably, Santosh, I'm just coming to you, but probably just one quick follow-up to that initial answer that you gave, right? So I'm presuming that you are taking a passive strategy both for the large cap category and the mid cap category, but in the small cap category, you would choose an actively managed fund. Would that be a fair assessment, or am I wrong?
Yeah. For now, Neeraj, I would go with a actively managed fund in the small caps, but I will not hesitate to add a mid cap, a passive strategy there as well, if it is a very longish horizon, again, beyond, let's say, 15 years or so, definitely. And in the active space, I like schemes like the Bandhan small cap. Of course, their CIO is managing it, Tata, HDFC, the credible names, because the performers, the top performers keep changing, so we can't keep chasing returns. But these are the credible names who have sort of proven themselves over different market cycles.
Wow, 15 years. Santosh, you have clients who stay invested for 15 years?
Of course. So let me also stick my neck out and tell you, you can't argue with what Prablin's view is, but I have a thought which maybe I'd like to share. The growth of the passives or the index funds have had their share under the sun over the last few years. But just think with me for a moment that the growth of the passives and also these index strategies at some level are actually going to have an inflection point where you are naturally going to give the opportunity for active fund managers to also outperform. So therefore, I'm sticking my neck out and saying that I will choose both at mid cap and small cap. Active strategy any day over a passive strategy, number one. And number two, I'll tell you why, is because when the passive strategy is anyway going to get those flows, because people believe that it's rather to be in a basket rather than actively choose, it'll give you the drift for the portfolio manager to be overweight or underweight or do stock selection and therefore naturally outperform. Because when the index itself is going to see flows, by just the process of natural selection, deselection, or weight management, there is a clear opportunity, especially in the mid and small cap, to outperform the index. So I am saying if we have a 10-15 year view, I would choose an active fund both in mid and small cap category. Now, when it comes to large cap, yes, it's a little bit of information asymmetry there because there's a small set of stocks and the flows are not equivalent to small cap and mid cap. And there's also a lot of FI flows that come over there. I would still choose maybe a combination of active and passive strategy. But when it comes to mid and small, I would still go with actively managed strategy, even if it's for 15-20 years.
Okay. Just before we get to queries, so both of you, just one quick thing, because it might get a bit confusing because there's so much of discussion we've done on actives, passives, etc. So not an exhaustive list again, but Prablin, one actively managed small cap fund that you think is good. I'm not saying it's the only one, there could be many, but one name which people can go and research based on their comfort level. One actively managed small cap fund.
Okay, I'd like to give two. Tata, for the way they've managed the downturns, and Bandhan, riding on the fact that their CIO, Mr. Manish, is managing in it. I think he brings in a lot of skill sets, so I would consider Bandhan as well. So two funds started.
Okay. So Tata and Bandhan, I hope I got those right. So that's from Prablin. Yes. Santosh, what about you? Again, not an exhaustive list, just indicative.
I will go with Motilal, just a relatively new fund, less than 1 year track record. And another fund is Edelweiss, which has got a phenomenally good track record. So my first bet is Motilal and second is Edelweiss.
Okay. Viewers, remember, this is not the only set of funds that they might be comfortable talking about. Indicative list, please do your own due research as well. And come in with a longer time horizon. That is something that both our guests have said. that you need to do, because there could be a volatile ride. It could well be in the next 12 months these funds may be underperforming even to the fixed deposit. It could well happen. So come in only with that long-term view in mind. Thank you so much, both of you, for this. So this was really nice. But we have maybe a few queries, and I'd love for you to maybe try and help our viewers who have asked these queries, if you're comfortable. So the first query is from Anand. Anand is from Ahmedabad. Anand's age is 45 years. Anand is asking, is it a good idea to invest in the ICICI Prudential India Opportunity Fund? Anand is looking for a long-term investment. I'm presuming, therefore, over 5 years. Probably any thoughts here?
ICICI India Opportunities, Neeraj, is a thematic fund, and it is with a large cap tilt. The basic premise on which it is based is that they're looking for those schemes which are, those stocks which are currently, slightly beaten down, and there is enough opportunity for them to bounce back. The top holdings at this stage are the prominent private sector banks. Then some names from the auto sector like Maruti, some of the tech companies, and little pharma. That's the top 10, the combination which is there in the portfolio currently. And I think it's a good scheme for investors to hold in the active space. But again, he has to take it like more like a large cap kind of fund in his portfolio. But I think it can be a very good scheme as an add-on to a portfolio, definitely.
Okay, thanks for that. Santosh, any thoughts here? I mean, maybe we can just take a quick thought from you as well on this.
No, I think it's a good fund, and considering it's thematic, I am also confident that when the themes change or when the sectoral breakup changes, that the fund will be nimble to capture those new changes, momentums, and trends. So therefore, especially a fund like this, when you choose it well, the longer you keep, you're allowing the fund to itself naturally evolve, and it will work well for you. I think it's a good bet to continue.
Okay. The next query, Santosh, this is for you, is coming in from Mahesh. Mahesh is age 37 years. The goal is a retirement plan. Mahesh invests 1.35 lakh rupees per month through SIPs and has a time horizon of 14 years. Okay, Mahesh is asking to review the whole portfolio. Let's try, Mahesh. I don't know if Santosh or Prableen can help very actively with that, but let's still try. So the core funds in Mahesh's portfolio: HDFC Focused 30,000 rupees SIP, SBI Contra 20,000, MOSL Mid Cap 20,000, Tata Small Cap 20,000, Tata Mid Cap 150 Momentum 10,000. And the satellite funds are HDFC Defense, HDFC Pharma, Tata Digital, MOSL Capital Market. So that's about 9 funds. Santosh, loaded question. Can you reply?
So Mahesh, it's commendable that you actually got a very nice time-bound and quantum-based plan for retirement. In fact, you start off on a good note, but I have a little bit of a difference of thought here in terms of your core portfolio and satellite portfolio, just to help you bring you up to the speed that when you choose well diversified, either a flexi cap or a multi-cap fund, bulk of your satellite portfolio will get well represented even in your flexi cap and multi-cap portfolio. For example, whether you want to play a defense theme or a PSU theme or a digital theme, you would notice that some of these exposures are already present. You don't have to just keep adding more line items by increasing the number of funds. In fact, when I look at your core portfolio, it's good. You have a large cap, you have a mid cap, you have a passive fund, well balanced. Now, every now and then the thematics keep changing. In fact, the themes that are doing very well today possibly may not do well 4-5 years, considering you have a 15-year horizon to do your SIPs. Similarly, the ones that are doing well today were not anyway present 4 years, 5 years ago, and were not relevant then. So my simple take is, while I appreciate your plan for retirement, I appreciate your SIPs and the effort that you've taken to break it down, consider how you can reduce the satellite exposure and increase your core exposure to well diversified funds which have the luxury of keeping the themes and sectors and the opportunities present in the market flexible. I think you'll do better.
Okay. Okay. Thanks for that, Santosh. Last question, probably this is for you very quickly. Vimal, age 50 years, wants to invest 5,000 rupees SIP on Contra, Flexi and equity hybrid funds, looking to create 25 lakhs in 5 years. Is this a viable plan?
Okay, so he wants to invest in flexi, equity, hybrid, and contra with a 5-year view. 5-year view is okay, Neeraj, with these themes, a flexi cap, contra, and equity hybrid, definitely. I'll have to do the math actually to tell him whether 25 lakh can be created or not, but looks slightly difficult, just with a back of the envelope calculation. I think he'll have to increase his SIP amount to reach his goal. And with this SIP of 5,000, honestly, I think he can just split it between two schemes for now. So flexi cap and probably a multi cap. I think a combination of something like that. Two funds should be good enough. Three aren't really needed.
Yeah, but yeah, just very quickly, I mean, even though we haven't done the math, Vimal, but it's easy to do. I mean, 5,000 a month will independent of however benign Prablin might be, you will not reach that goal, no matter what kind of returns do Indian markets create, because frankly, that returns are very high that are needed. I don't think that can happen. So you'll need to change the size of your monthly SIP. I'm presuming 5,000 is split between everything and not 5,000 individually. But even then, it might be slightly difficult. But okay, on that note, Prablin and Santosh, thank you so much for taking the time out and being with us on this leg of the Mutual Fund Show. Really appreciate your time.
Thank you, Neeraj.
Thank you.
All right, and viewers, lovely doing this show today. Thanks for joining in. Stay tuned to NDTV Profit.